What's good, YouTube? It's your boy Charles Enoch, and as you guys already guessed, another episode of Invest in Myself is ahead of us. So run the clip. So in today's episode, we'll be doing another scenario on how to choose which credit card to pay off first when you're using the Velocity banking method. So I keep getting a lot of emails about, hey, how do you calculate that simple interest again? I have this card and this card with this interest on there and this interest. Which one should I pay off first? So it's only right that we go over another example, right? But before we go over the example and head to the whiteboard, I'm gonna ask you, go ahead, smash that like button for me, make that thing turn blue. Also, if you're new to the channel, take a little bit of time, hit that subscribe button for me. I do appreciate everybody that does this. It does help me reach a higher audience base. All right, with that being said, enough of the small talk. Let's get to the whiteboard, get to another scenario, and let's figure out which credit cards we should be paying off first. Let's go. All right, so we at the whiteboard. You already know I get straight down to business. If you guys watched the last episode, the income and expenses and everything's going to be pretty much set up the same. The basic concept that we're wanting to really get is how to calculate that simple interest. But we will be going through everything just in case you didn't watch video one, or if you just want to watch it over again and just get that review. So let's get it started here. So we got the income of $2,500. Expenses are going to be $2,200 a month. Part of the expenses are the rent, which is going to be rolled into there. So remember, expenses are $2,200. Just the rent is $1,000 of that $2,200. This leaves a cash flow of $300 that this individual will be left with. Now, individual has two credit cards and they don't know which one to pay off first. Pretty much which one is charging me more interest in regards to the cash flow. So we have credit card number one, and this individual has $7,000 worth of debt on it with an interest rate of 25%. And the individual has another credit card. It's going to have $15,000 in debt in it, and the interest is going to be 17%. Now, we're just going to keep it simple. Credit card 1 and 2, the minimum payment that you have to make monthly is just going to be $200. So which one is going to be the one that's charging us the most interest in reducing our cash flow? Let's figure that out here. So we're going to go here. Which one do I pay off first? So we're going to look at credit card number one. It's going to have the $7,000 on it. We're going to times that by 0.25, which is the 25%. We're going to divide that by 12 because there is 12 months in a year. We're going to get 145.83 as the monthly interest on credit card number one. Now, credit card number two, the one that has 15,000 on there, we're going to times that by 0.17, divide that by 12, and we're going to get $212.50. So the credit card that we're going to want to pay off first is credit card number two, because that's reducing our cash flow the most. All right, now since we figured out which credit card to pay off, let's quickly look at the method on how we're going to be paying this off and how to figure out what the true cash flow is. Because on paper, the $2,500 we get minus the $2,200 in expenses equals $300 cash flow, but we don't know the interest being charged. We have to minus that here. So let's go to the method. So step number one, we're going to pay our rent, and then we're going to pay credit card number one, the minimum payment of that $200. And we're going to pay that with our cash out of our bank account. And that's going to be $1,200 total. Now, step number two, we're going to put the rest of the income on credit card number two. And that would be $1,300 would be the rest of our income. So the balance on that credit card number two, remember, it was $15,000. When we put the $1,300, it will make it $13,700. Now, step number 3, we're going to pay all the other expenses with credit card number 2, and we're going to pay $1,000 because that would be the rest of the expenses since we used $1,200 already, and the total's $2,200. So, if we just break it down, you put $1,300, part of your income, on credit card number 2. And then $1,000 of it went out for expenses. This is the $300 of cash flow that you have left over per the month. So the $2,500 minus the $2,200. But we're trying to see what the true cash flow is going to be. So step 4, the balance on credit card number 2 after we add the $1,000 worth of expenses are going to be $14,700. Now step number 5, we're going to use that simple interest equation because we have to remember simple interest is calculated on a daily basis. So depending on what your debt amount is per that day, that's how much it's going to charge you per day. So if the balance is $13,700, we're going to times that by 0.17, that is the 17% that is charging us. We're going to divide that by 365 because there's 365 days in a year. And it's going to equal a daily balance or a daily debt charge of $6.38 per day when the balance is $13,700. Now we're going to look at the simple interest calculation on when the balance is $14,700. So we're going to times that by the 0.17, which is that 17% interest is charging us, divided by 365 days in a year, right? And that's going to equal $6.84 per day. Now, we're just going to do some easy basic math. Let's say 15 days out of the month, so half of the month, that balance was at $13,700. And then the other half, you had to pay $1,000 in expenses, so it bumped it up to $14,700. So what we're going to do here, we're going to take that $6.38, we're going to times that by 15, because it's 15 days, right? And we're going to get $95.70 of total interest that it's charging us. Now we're going to take the $6.84 as if the debt balance was the $14,700, times that by the other 15, the other half of the month, we're going to get $102.60. We add that together, the total interest is $198.30. So let's see what the true cash flow is after the interest is added up. So our cash flow per there is $300. So we're going to take our $300, we're going to minus that by $198.30. This is going to equal $101.70 of true cash flow. Now, a couple reminders here. Remember, every time the debt balance goes down, then the true cash flow is actually going to increase. So next month is going to be even higher than that. And the month after that, it's going to be even higher. So you want to try to shove as much money in there and keep it in there as much as possible to keep the per day balance lower. So again, if you need to write this down about how to calculate that simple interest on your credit cards, and if you have 4 or 5, you're going to be doing 4 or 5 equations to figure out which one is charging me the most interest. And that's the one you probably want to get rid of first, because it's going to increase your cash flow even more than the other ones. No matter what the debt amount is, you need to do the equation to figure out which one is truly hurting you the most, and that's the one that you're going to use your Velocity Banking method on. So I really do hope that this helped. Scenario number 2, and if we do need to do another scenario, just comment down below. You can even put your numbers down if you want to. You can email me and I'll try to respond back to you, or even you may have your stuff on the board here. So with that being said, if this was a good example, please go ahead and hit that thumbs up button for me, hit that like button. If you're new to the channel, go ahead, take a little time, hit that subscribe button. I really do appreciate it. It does help me reach a higher audience base. And like always, you guys have a good weekend. Peace out.